1. Start with energy, explain with authority, highlight with emphasis, and with warmth. Rivian Automotive Inc. is currently trading at exactly 14.45 USD, seeing a decline of 0.54 USD or 3.58% so far in today's intraday session. If you are watching the charts right now, you are seeing a classic battle between short-term capitulation and long-term accumulation. And frankly, most people are misreading the tape. The red on their screen might suggest weakness, but if you look closer at the order flow and the volume profiles, a completely different story begins to emerge. One that isn't about selling trucks, but about selling the very brain that makes an electric vehicle function. Most investors look at Rivian and see a company burning cash, struggling to ramp up production, and fighting for a slice of the market share against giants like Tesla and Ford. That is the expectation. That is the easy narrative that headlines feed you. The reality, however, is significantly more complex and far more interesting. What we are witnessing right now isn't just a car company trying to survive. We are watching a subtle but aggressive pivot into becoming a technology platform. The market is punishing Rivian today for its manufacturing burn rate, but the smart money is quietly positioning for the realization that Rivian is effectively becoming the operating system for the legacy automotive world. The drop to 14.45 USD isn't a signal of failure. It is a repricing of risk as the company transitions from a pure hardware manufacturer to a hardware-software hybrid that could license its architecture to the very competitors trying to crush it. Let's break down exactly what is happening on the floor today. We are seeing heavy sell-side pressure in the opening hours, likely driven by macro headwinds affecting the broader high-growth sector. When interest rates remain a talking point and bond yields fluctuate, capital flees from capital-intensive names like Rivian. You see this across the board. Whether you're trading on a Fidelity mobile app or checking your Robinhood stock trading account, the sea of red in the EV sector is palpable. However, the volume on this dip is telling. It is not the panic selling volume we saw back when they missed production targets in previous years. This is controlled distribution, likely from short-term swing traders exiting positions before the next major catalyst window opens. The narrative you need to understand, the one that creates that tension between what everyone thinks and what is actually happening, centers around the Volkswagen joint venture. Everyone knows about the deal. It made headlines, but few understand the mechanical implication of it. Rivian didn't just hand Rivian $5.8 billion because they like the R1T. They did it because their own software division, Cariad, failed to deliver a competitive zonal architecture. This is the aha moment. Rivian's value proposition is no longer just about how many trucks leave the Normal, Illinois factory. It is about the fact that the Scout brand, Audi, and Porsche might eventually run on Rivian's neurological network. That changes the valuation model entirely, from a low-margin auto manufacturer to a high-margin tech licensor. When you look at the intraday action at 14.45 USD, you have to contextually compare this to the broader sector. Tesla stock is often the bellwether here, and when Tesla creates pressure on pricing, the entire industry feels the heat. But Rivian is decoupling in terms of strategy. While Tesla chases autonomy and robotaxis, Rivian is chasing the infrastructure of the vehicle itself, the zonal architecture that reduces wiring harness weight, lowers chip count, and simplifies the manufacturing process. This is what VW bought. They bought a shortcut to the future. So while the ticker shows a 3.58% drop, the fundamental thesis has actually strengthened because the integration of this technology is reportedly moving faster than anticipated, with winter testing for reference vehicles already on the horizon. Let's talk about the financials because we have to be realistic. You cannot ignore the cash burn. In the most recent reports, we saw gross losses per vehicle that would make a traditional accountant faint. Tens of thousands of dollars lost on every unit sold. This is the valley of death that every manufacturing startup must cross. It is the exact same precipice Tesla stood on during the Model 3 ramp. The difference here is the safety net. That VW capital injection acts as a massive bridge, carrying Rivian through the launch of the R2 platform in 2026. Without that cash, today's price of $14 would likely be single digits. With it, there is a floor. Investors using Schwab Intelligent Portfolios or managing their own individual brokerage accounts need to weigh this cash runway against the execution risk. The risk isn't bankruptcy anymore, the risk is delay. The R2 platform is the critical piece of the puzzle. The R1T and R1S are incredible halo products. They establish the brand as the Patagonia of cars. They are rugged, capable, and premium, but they are expensive and complex to build. The R2 is designed for mass manufacturability. It is the Model Y moment for Rivian. If they can produce the R2 at scale with a positive gross margin, the stock at $14 will look like a historical anomaly. If they stumble, the market will be unforgiving. This binary outcome is what keeps volatility high and what makes the stock so attractive to active traders on platforms like Interactive Brokers Trading or SoFi Active Investing. We also need to discuss the macro environment because Rivian does not exist in a vacuum. The cost of borrowing money affects their customers' ability to finance these expensive vehicles. High rates are a direct headwind to demand. We have seen this with the softening of the EV market globally. Ford has pulled back, GM has pulled back. The hybrid narrative is gaining steam. Yet Rivian is doubling down on pure EV. This is a contrarian bet. They are betting that by the time the R2 launches, the rate environment will have normalized and the consumer will be ready for the next wave of electrification. It's a high-stakes game of poker played with billions of dollars in capital expenditures. Now consider the institutional activity. If you look at the 13F filings and the dark pool data, you see a lot of churning. Some big funds are trimming, wary of the execution timeline, while others are slowly building positions, likely viewing the VW deal as a validation stamp that de-risks the technology aspect of the company. This institutional tug-of-war is exactly why the stock feels stuck in this range, chopping between support and resistance levels. For a retail investor using Fidelity Investments or perhaps dabbling in fractional shares on Robinhood app, this range-bound action can be frustrating. But in technical analysis, long periods of consolidation often precede explosive moves. The energy is building, the coil is tightening. One specific angle that is often overlooked is the commercial van business. The Amazon partnership was the original anchor, but the exclusivity ending actually was a bullish development. It allows Rivian to sell its EDV to other fleets. We are talking about AT&T, DHL, major logistics players who are under pressure to decarbonize. This is sticky, recurring fleet revenue that provides a baseline of demand that consumer-facing companies don't always have. While everyone focuses on the consumer trucks, the commercial side is quietly scaling, providing a steady hum of production that helps absorb fixed costs at the factory. Let's pause for a second and think about the product itself. Have you sat in a Rivian? The user interface, the software stack, it is arguably second only to Tesla, and in some UX aspects, it is superior. This matters. In the modern automotive era, the car is a software-defined vehicle. The driving experience is defined by the screen, the updates, the connectivity. This is why the terms NVIDIA stock discussion is relevant here too, as the compute power required to run these vehicles is immense. Rivian's decision to control the full stack, from the ECU to the cloud, was incredibly expensive and painful in the short term. It caused delays, it burned cash, but in the long term it means they own the data, they own the customer relationship. They are not beholden to third-party suppliers for their critical features. This vertical integration is the moat. Today's price action of down 3.58% also reflects the broader skepticism about EV demand in the United States. We're seeing inventory pile up for some manufacturers. Dealers are turning away allocations. But Rivian operates a direct-to-consumer model, similar to Tesla. They don't have a dealership network choking on inventory. They produce to order, largely. This lean model is efficient, but it puts tremendous pressure on their logistics and service network. If you live in a major hub, getting a Rivian serviced is fine. If you live in rural America, it's a challenge. Expanding this service network is another massive capital cost that weighs on the balance sheet and scares off the more conservative Fidelity mutual funds managers. However, the partnership with Volkswagen could eventually alleviate some of this. Imagine a world where Rivian vehicles can be serviced at select Volkswagen or Audi dealerships. That isn't on paper yet, but it's the logical extrapolation of a deep strategic partnership. If that happens, one of the biggest bearish arguments, the lack of service infrastructure, evaporates overnight. This is the kind of second-order thinking you need to apply when analyzing a stock like this. You have to look past the press release and ask, what does this relationship unlock in 5 years? Let's switch gears to the technicals on the chart. At 14.45, we are hovering near a psychological support zone. If this level breaks, we could see a flush down to the 13s where stronger historical support lies. Conversely, any positive news regarding R2 progress or an earlier than expected interest rate cut could send this ripping back towards the $17–18 range. For those of you engaging in self-investing or using investing sites to track your portfolio, setting alerts at these key levels is crucial. You don't want to be reacting to the move after it happens, you want to have your plan ready. The competitive landscape is also shifting rapidly. We mentioned Tesla, but what about the Chinese EVs? BYD is a juggernaut. While tariffs are keeping them out of the US for now, they are pressing hard in Europe and South America. Rivian's focus on the North American adventure lifestyle gives it a unique brand insulation. A BYD Seagull is not a substitute for a Rivian R1.